I'm Chris Brummer, a professor of law at Georgetown and the host of the Fintech Beat podcast. And I'm here as your moderator, along with the CFTC's former Director of Innovation, Dan Gorfine. Welcome, everyone, to Town Hall on how Fintech can assist small businesses. Now, this is a critical time in the world, especially as the global economy encounters unprecedented financial distress, seeing not only a dramatic deceleration of the economy, but also unprecedented layoffs that dwarf any period the country has seen since World War II. But it's also an opportunity to look forward to pragmatically brainstorming how new technologies can help people access capital and federal assistance both now and after the crisis subsides. And with fintech in the news and such a major player, particularly for individuals and small businesses, we were really looking to help kickstart that discussion. And I personally wanted to lend my own thanks to all of you tuning in, as well as the Georgetown University Law Center, the Center for Financial Markets and Policy at Georgetown's McDonough School of Business, and of course, CQ Roll Call. Just wanted to also give you an opportunity. I know that you wanted to help set the stage for our first panel.
Great. Thanks so much, Chris. It's great to be on with you. And I want to thank all of our excellent participants and all of you that are joining us virtually today. You know, Chris, as you said, these are truly exceptional times, and we certainly appreciate what many of you are doing out there to make life a little bit better for others. On the government side, which we'll be diving into today, we recognize that this has been an incredibly difficult period and applaud efforts to date to roll out trillions of dollars of relief to individuals and businesses alike. For today's discussion on the state of small business in America during this crisis, I wanted to level set and share a few data points. As many of you know, there are more than 30 million small businesses in the United States, and these small businesses, at least before the crisis, employed nearly 60 million people. According to the National Small Business Association, which we have represented today on our first panel, small businesses employ 57% of the country's private workforce. Now, when it comes to emergency funding relief, according to SBA figures as of late Monday this week, the Paycheck Protection Program had approved nearly 1 million applications for a total of $250 billion in allocated funding. Now, also, as many of you know, the cap of the PPP program is $350 billion, and by most estimates, we will hit that in the coming days. So with all of this, we still have so many unanswered questions that we're going to discuss today. It's really hard to know economically where we go from here. How will small businesses fare, and what can we do to help? How can and will technology adapt so that fintech models become even more responsive to the inevitable shifts we will see coming out of this crisis? So with that, let me turn it back to you, Chris, so we can introduce our first panel and get going on the day.
So thanks, Dan. You know, these kind of discussions are really critical, but they're hard. And they're hard because on the one hand, you have to have a conversation about fintech and financial technology, and that is inherently complicated. At the same time, when we're talking about today's discussion, we have to continue fintech conversation against the backdrop of small businesses and the unprecedented challenges that they're encountering, and to understand a little bit about how small businesses access capital and what's the governmental backdrop at the moment. And hopefully from there, we can have a really productive conversation, again, about how fintech can play a productive role in speaking to these challenges. And so with all that said, our panel is really one that helps to bring some of the leading experts and folks who are on the front lines to think through, well, what are small businesses encountering? What are the challenges that they've faced thus far? We have on our initial panel, Todd McCracken, the president of the National Small Business Association, Julie Stitzel, the vice president of the Center for Capital Markets of the Chamber of Commerce. And we have Anne Marie Malem, an advisor at FS Vector, who has had a distinguished record of service that has included, among other things, service as administrator of capital access for the Small Business Administration. With all that, thank you so much to all of you for joining us. And I think I'm going to start off the conversation with you to again contextualize really how the state of small business funding has evolved, how it was just prior to the crisis, where you've had experience over the last couple of years, and what is the state now? Obviously, the economic injury disaster loan program predates the crisis, but two also had to be reformed. But again, just how is it that small businesses have been able to access capital both in good times and crisis? And where do we stand now?
Well, thanks, Chris. I'd like to put a little perspective into what's happening today with particularly the Paycheck Protection Program. Um, Last year, the Small Business Administration made about 52,000 loan guarantees to 52,000 businesses, and it was about $23 billion worth. And that's a big year. That's a lot of work for the SBA. What they've done really in the last almost 2 weeks is give approximately 300 billion in guarantees to about 1.2 million businesses. So what the SBA and the banks are doing right now, despite the clunkiness, despite the problems, despite the issues that all borrowers and bankers and the SBA are having, really has been Herculean. I think part of some of what we'll hear more about today and what's going on stems from the fact that there is far more demand than even the 1.2 million businesses that are being able to participate. We have 28 to 30 million small businesses in this country, so there's a huge demand. And the SBA system, the beautiful part of this, and I know I'm presuming where this whole conversation will lead, and I'm excited to hear from the fintech players on the panels today, is that this is the first time that the SBA has allowed non-bank participants. So I'm really looking forward to these fintech companies working directly with the SBA and making some real progress after this crisis to bring technology to not only government agencies like the SBA, but to the whole financial system.
Great, thanks, Anne. And now I'm going to turn maybe first to Todd and then Julie, and really the same question for both of you. Todd, you're the head of the National Small Business Association. What are you currently hearing from your members or your constituents? You know, what is the current state of small business in America, and what kinds of capital needs are they raising with you? So, Todd, let me start with you.
It's good to be here with you, by the way. Thanks for doing this panel, and thanks for inviting us to participate. But I don't think I have anything very surprising to say on those fronts. They need still in cash. We are finally hearing from a lot of our companies. They have been able to access the programs that are out there, and they're finally getting some of their money in the door through those programs. So that is beginning to help. But before this happened, of course, you know, small business capital is never easy. There's always more demand than small businesses believe they can access. It's because of the nature of small business. I mean, we have a lot of startups, new companies without a track record. It's just the nature of small business that raising capital and getting loans for growth is always going to be a bit of a challenge because of who we're talking about. But we are in a better spot, you know, 6 months ago than 2 months ago than we had been for quite a while in those regards. But I think the thing that's really striking to me that's changed is, you know, 2 months ago, a typical business was seeking money from whatever source to grow because they had an opportunity in front of them that they wanted to take advantage of. And they had a vision for their company and where it could go. Today, they're seeking money to survive, to stave off their, you know, the bills they got to pay, to maybe just keep most of their staff on the payroll so that when things turn, they can resume functioning. And it's a whole different mindset, both for the lenders and for the businesses right now. It's because the future is so murky. We don't know if there'll come a point where we really will have a V-shaped curve and go straight up. It's seeming more and more likely that as we move out of this, that some companies will be in a position to resume operations, but some of their vendors and some of their customers might not. So what does that mean? So we're in an unknown space right now, and that is, I think, the chief challenge for companies. If they can get access to money, what do they do with it? Do they spend it right now to keep staff on board, or do they find a more productive and different use for it? Those, I think, are ways that I think the fintech community and the capital community can help small business owners kind of think through. What is the best use of whatever money they do have.
Yeah, thanks for that, Todd. So, Julie, let me come to you, and from your perspective, and at the U.S. Chamber, what are you seeing and hearing? Following on Todd's remarks.
Yes, and I want to echo Todd and say thank you so much for hosting this great discussion. So the Chamber is in an interesting spot because we work with the banks, the fintechs, but we also represent the small businesses. So building off of Todd's comments, when this first started, I established a relationship with a small business in Florida and have been using her as my barometer throughout this process. So when all of this started happening and PPP was announced, I touched base with her and she said, "You know what, Julie, this is a car running out of gas. We're running out of gas right now, and as long as we can get the funds to buy the gas to get the car started again, that's great." The delay in getting the funding out the door and all of the hiccups that we've had along the way have changed that context significantly. So I checked in with her this weekend and she said, "We are in a completely different scenario. Our car has crashed. And right now I am looking around to see if everyone in the car is okay, AKA their employees. And then I have to assess the car, their business, to say, is it totaled? Is it a complete loss or is it repairable? So that we can, to Todd's point, make decisions based on that. And do we still want the same car? So the time it's taking to get the money out the door is impact. It has accelerated the sense of urgency significantly, and we absolutely need to make sure that there's additional funds to keep the PPP program running.
Yeah, well, just building off, and I've heard now these words clunky. We're certainly getting, which is a wonderful descriptive term, because you're not only thinking about sort of an old-fashioned car, but the very idea of an old-fashioned car seems to really reflect an old-fashioned way of getting money, of creating the kind of payment rails to get money to those desired uses in the economy. And when you're looking at the federal response, I mean, again, think with these words like clunky and timeliness issues popping up, what do you think are the weakest links to date? Is it just the size of resources that are being made available at the federal level, or is it more of a challenge with the size of the disbursements that are being made at the individual business level, or is it something else? What are you seeing as sort of looking at that SBA Treasury / small business interface? What are you viewing as the weakest links?
Well, that's a really good question, and I hadn't really thought of it that way, but let me respond. First of all, the SBA hasn't dispersed anything yet. So that's a challenge yet to come. In the 7A program, the banks are dispersing. And then what they'll do is they'll go to the SBA when their customers have said, yes, this is how I've used the funds, I followed the directions. Then they'll ask the SBA to honor the guarantee to repay the loan. This is the way the 7A program works. And of course, the 7A program itself has myriad requirements, hundreds of pages of requirements, and they've stripped away most of it for this program, which obviously was totally necessary for any kind of speed. Hopefully they'll do the same thing in honoring the guarantees, that they will not have to review things and have attorneys look at things and have those guarantees build up. Hopefully they'll send that request in some automated form right to the Treasury to get that money funded. But I think the things that are hampering speed and effectiveness really are two things. The systems certainly. The systems are not they do it. They're capable of doing what they've been doing, but there's so much that is still manually done. There's so much that technology could do now for the system, and not just for the SBA, but also for lenders.
And I just want to jump in there. So you're saying, like, when you're talking about the systems, when we're talking about the infrastructure, you're saying that part of the problem is both on the lending side, and it's the infrastructural issue on the. It's not just one, but it's a confluence of maybe paper-based or other challenges.
Absolutely, and logic, and where things have to be input manually, and where things have to be signed in paper. I mean, one of the things that we did just 4 years ago when I was there was finally passed a rule allowing the SBA loans to be signed electronically. That took, I don't know, a year and a half to get that decision. I mean, the rulemaking. So it's contracting systems and rulemaking systems, but that has led to a situation where they are not operating as efficiently technologically as they could be. I don't mean that as a slam. I mean, as far as federal agencies go, the SBA is probably one of the more nimble ones. But it's what it is.
So I want to pick up on this and do a deeper dive into some of the pain points that we've been hearing about. So I'm going to rattle off a few, and then maybe just to reverse order, I'll start with Julie and then go to Todd. But here are a number of things we've been hearing. So one, for example, is an issue around KYC, or know your customer. If you're a small business whose bank is not participating in the program or has hit capacity, can you go to another provider and get approved quickly enough? That's one thing we've been hearing about. Speed to actual funding. I mean, this gap between approvals and actually getting money in the bank account. Julie, you mentioned that as creating an additional pain point. And then we've heard some questions about legal clarity or certainty. So, for example, small businesses have to certify that it's a necessity to receive these funds to continue with operations. So we've heard potentially for some larger businesses, can they comfortably certify that point? So I've thrown a few of those things out there. Julie, starting with you, I mean, picking up on any of those pain points or others, which are most problematic, and what solutions do we have?
Yeah, so I would start with the speed. We have to get the money out the door, and the introduction of fintechs to be able to start lending is such a welcome addition to really what's an all hands on deck problem. And one thing to note too with the fintechs is, their customers, like the banks who are also doing a phenomenal job in trying to get money out the door as well, is, they are already working with a lot of these small businesses. So they have the familiarity and the comfort level, the Squares, the Intuits, the PayPal, and we'll hear from some of them, from some of them later. So the biggest pain point, I think, is getting the money out the door, because these small businesses do not have time. They probably were sitting on 3 to 4 weeks of cash reserves. They've spent that from last month, and they need to get the money this month if they're going to make payroll.
Yeah, Todd, do you want to jump in on that as well?
Yeah, and to add to that, there's just a significant, I think, pain point may not be the right word, but there's the very smallest companies are in most danger of being left behind by all this, because they're more likely to be service-oriented businesses. Who may never had a loan before, so they might not have that kind of banking relationship, and so they might not even be first in line before they do the banking, even if that bank is offering the loans. Then if they're self-employed, they didn't get guidance until yesterday in terms of how that would even work and what they could get forgiven. And it was been kind of a big unknown what exactly a self-employed person could get forgiveness for until now. And only now, so now the program is rapidly running out of money, and now they know whether, so they're just now starting on that loan. They might not get one. And then if they've applied for the other loan program we haven't even talked about, which is the Economic Injury Disaster Loan Program at the SBA, they found out in the last week that, in fact, the $10,000 advance probably isn't $10,000. It's something much less than that. And even if they can get one of those loans, they at this point they're not going to get the full amount. They're going to get something much less because the program's running out of money. So I think those very smallest companies that are the least financially sophisticated, that don't have the ongoing banking relationships, are the ones that might just get left out, at least until the programs get re-upped by Congress, assuming that happens.
Well, thank you so much to all of you for providing this kind of perspective and providing, really, quite frankly, a little bit of color as to these words that we've heard many times: the clunkiness, the speed issue, and yet the fact that we are at a point in time in which small businesses, particularly the smallest businesses, need money now. It's a question about payment rails. Interestingly enough, we had a very interesting question just now on Twitter from CoinDesk relating to the role that not only fintechs but also cryptocurrencies can perhaps play as payment rails. But at the end of the day, there's this vital question about how can we get money to these businesses that are struggling. And thank you again so much for making it on. I think with that, we're going to transition now to our fintech perspectives. And we're going to bring on our first participant, Sam Tosic, who is the head of from Cabbage. Sam, thanks so much. Thanks so much for joining the town hall. And Dan, why don't you start us off?
Great, thanks, Chris and Sam. Great to see you. So we understand that fintechs can serve as agents or partners with SBA lending banks, or they can also serve as direct lenders. Can you help explain to everybody how this works, and to what degree can fintechs truly participate in some of these federal stimulus programs that we've been talking about?
That's right, Daniel. Thank you so much for having me on. Thanks to Chris, too. This is what Fintech was born for. Fintechs have the existing financial, the technology, and of course the operation and process structure to take a small business that they may have never interacted with before and onboard them to what, quite frankly, is a fairly technical and onerous program. Now, from the standpoint of the small business borrower, it doesn't look that hard. It's 2.5 times your monthly payroll effectively. The rules and the regulations that live under that borrower application are fairly complex and onerous about how a lender has to onboard that customer for the purposes of the Bank Secrecy Act and a money laundering, OFAC, know your customer, know your business requirements and regulations, as well as how to parse out all of the relevant and irrelevant, included and excluded expenses around payroll. Now, a fintech in normal day-to-day business, the entire point is to alleviate all of those friction points with your normal banking experience and automate that as best as possible in a way where the borrower is bringing their data assets to the equation already and doing away with the necessity to sign physical forms or do on-site evaluations or things like that. And so in this era of the Great American Lockdown, there's great value in that and great value in reducing the time and again, that friction point there. As fintechs begin to integrate with banks as third-party technical service providers or agents for this program, or become approved to do this directly, the real value is reducing that marginal cost to bringing a customer into this program. I think we've heard, many of us have heard anecdotally, as well in some news reports, that large banks are only working with pre-existing clients. And that's not just pre-existing deposit account holders. Those are pre-existing customers that have borrowed with the bank before. And the reason that is the larger banks simply don't have the technical resources to efficiently move smaller businesses or customers they've never seen before through the process in a reasonable amount of time with a reasonable amount of cost for the bank. So they're prioritizing the low-hanging fruit, if you will. Well, in the case of a fintech, every single interaction is going to look and cost about the same. So when we talk about the smaller Main Street businesses, the bakers, the auto mechanics, the florists, that really have not been fully served by this Paycheck Protection Program loan yet, it's been mostly the larger businesses with access to accounting resources. This is where fintech's going to be a great equalizer, assuming that Congress can upsize the fund here. And that's very important. Todd mentioned that independent contractors and sole props just became eligible last Friday, and only late last afternoon we received that guidance. Well, there's a huge pent-up demand, and fintechs can be able to churn through those eligibility requirements very quickly.
So that's really interesting, because basically you're telling us a story of technology. You know, the fact that when you have technology, technology and technological infrastructure allows you to scale things, and it allows you to handle multiple processes with a very high degree of efficiency, and that you're telling us a story that really reflects in some degrees the way the lending environment, the small business lending environment, looked like prior to this crisis, which was that many of the fintechs had become sort of central players in lending to small businesses, and that was part of their value proposition. One of the really interesting things, Sam, that I've read, and maybe you could explain to me, because I'm just trying to get my arms around it, is that a number of issues with how the program is being set out, and not only with primary origination, but with the fact that the SBA is taking the position that only approved SBA lenders can participate in the secondary market for the PPP program, and that this could be a big issue for lots of firms, especially those seeking to originate and process and serve as an agent for folks in the PPP program. Could you just sort of walk us through that particular observation?
That's right, Chris. It's a big problem that you're hitting on here, and a rather technical one at that. But at a super high level, I've talked to, call it, maybe 150 community bankers over the last couple of days here. Community banks, regional banks, fintechs, other non-bank lenders of the like, are in many cases experiencing a liquidity issue given the volume, the pent-up demand that they're seeking to serve on these Paycheck Protection Program loans. I don't think that that's a statement on banks have weak balance sheets right now or anything like that. That's really going to be an after-the-fact assessment here. What it is, and what is a statement on, is the way that this program was designed requires the lender to find that liquidity and find that capital on the front end, because you don't cash in the guarantee, you don't cash in the loan, or that later turns into a grant, until after the fact. And so if lenders want to serve their full borrower base, they need to access that liquidity. Now, we understand that the leverage ratio has been lowered. We understand that these loans carry a zero risk weight balance, but that doesn't absolve banks and other balance sheet considerations companies from ignoring their normal day-to-day operating procedures. And so many have gone out into the private markets to seek capital and liquidity to fund these loans. The issue with that is many of these institutions don't want to balance sheet these loans for a long period of time until either they can sell them back to the SBA, or there's some mechanism for the Federal Reserve to take these loans through an SPV or a window. So what we've come into is basically a bottleneck where lenders are making a hard decision about how much can we originate, given that we don't know how quickly these loans will move off the balance sheet. Once they do start to move, we don't know what the hold period will be. So they want to go out into the private secondary market and find brand name institutional partners to provide that liquidity, either as a pledge through collateral or just taking them off the balance sheet. But unfortunately, pre-existing SBA rules only allow for pre-approved SBA lenders with written approval from the SBA to engage in that kind of secondary market transaction. Now, it's my understanding the SBA is working, and Treasury working hard to resolve this, but it really cannot be, we really cannot wait to resolve this any longer, given that we do still have this huge backlog of 29 million small businesses that need to be served. and a number of lenders that are still trying to get into the program and access this liquidity. It's a very technical problem, but a really simple solution, which is SBA and Treasury, either through another interim rule or through the FAQs, simply need to say that that the congressional intent and the secondary rule intent from Treasury was fairly clear, and that the secondary market is open and the pool is warm and everybody can jump right on in.
Sam, I think we only have time for one last quick question. Let me ask you this, and I think I've seen some comments from you in the last week or so about the state of Main Street small businesses in America. You know, you all have insight into cash flow for these businesses. What does it look like right now? What are your expectations for the coming weeks? And will these businesses be able to survive?
It's a great question. Daniel, I was a little concerned to see some members of Congress that will remain nameless taking a victory lap on the PPP numbers thus far. Julie from the chamber had mentioned at the front end that the average small business has about four weeks of cash on hand. That's about 27 days according to JP Morgan. Well, the average small business in our definition here goes up to 500 employees. The Main Street folks, as you referenced, your local restaurant, your hair salon, they only had, and I say had intentionally, 10 to 12 days of cash on hand. They are making very difficult economic decisions right now about which employees to furlough or lay off, which bills to skip, what mortgage do they pay, their business mortgage or their personal mortgage. There is a massive conflation of commercial and consumer finances right now, and it will take years for the small businesses on Main Street to recover and unbundle that entanglement from their personal finances. We will need to continue to support them through this crisis. We need to fund the PPP with more money, and we also need to think about what's next. The Paycheck Protection Program only covers 2 months of payroll. It's very clear right now that there's a possibility this public health crisis could last far into the summer and potentially even longer. And it is absolutely time for Congress and the administration to think about what is after the PPP. Do we have people go through it again? Do we need to think about a different program? Do we need to get really creative with tax rebates here? Because the folks on Main Street are suffering, and we're going to see that in the economy for a long time to come.
Sam, thanks so much for this great but very sobering perspective. As we think about those questions and move forward with Usman Ahmed, who is the global head of policy with PayPal, and welcome, Usman. It's going to be very, very useful to get the perspective of not just the fintech firms, but also payment companies who are working in this space, and to get a sense of what PayPal is up to, since it was one of the very first fintechs to get approved for PPP loans. Usman, thanks so much for being able to make it and to join us.
Hi, can you hear me?
Yes, we can hear you.
But can you see me? I can't tell if you can actually see me or not, because it seems like my video is not working.
Oh, your video may not be working. Okay.
Yeah. All right. Well, we'll work on that. I'll go ahead and get started, and I'll try to work on my video.
Okay. Usman, PayPal has, as I said, been really one of the very first firms to be approved for the PPP loans. I think because now more are being approved sort of incrementally, it's a little bit of a drip drop kind of process. What exactly did this process look like for you? I think a lot of people are trying to figure out how exactly many other fintech firms and also payment companies are trying to think through how they should be navigating this. What did it look like from your perspective as the head of global policy?
Sure. So again, apologies for the video, but and thanks for inviting me to come and talk to you all. So it's just as everybody has said, kind of an unprecedented problem, and so an unprecedented process. And I understand some of the concerns and complaints, but the reality is the problem and the solution that needed to be created were completely, again, just novel. And so One more sobering statistic to throw at everyone is there was a fascinating National Bureau of Economic Research study that came out yesterday showing that in a study of 6,000 small businesses that 43% of them were closed already. And so when you're thinking about that many businesses that are closed, essentially, as Sam mentioned, kind of out of the ability to have any cash flow, Congress had to step in. And I think Congress saw fit to include fintechs because there was a realization that fintechs could, provide capital to a segment that was traditionally very challenging to offer to. And, Treasury and the SBA, as they were working through the creation of this program, they also saw to it that certainly, getting banks on board and as Ann mentioned, kind of building up the SBA's capacity to work with existing lenders, to work with banks was kind of a first priority. But I think, as Todd mentioned, kind of recognizing that it was going to be very, very tough to serve the smallest of businesses, Treasury, SBA, and Congress saw fit to include fintechs. And, I think that process has been created as everybody is steering the ship, they're building it, and guidance continues to come out. But I think, it's now a lot of the pieces are in place. And as Sam mentioned, I guess now the issue is, will there be funding going forward so that this can really start to reach some of the businesses that need it the most?
Yeah.
So, Chris, did you have a follow-on question?
Yeah, because and we'll get to this a little bit more, because it's being one of the very first companies to sort of enter into this process, right? I mean, PayPal is in a really interesting position, right? I mean, being the first sort of non-bank to sort of get engaged, and again, it's just interesting to get your perspective. We've already talked and we've heard from Sam before about the fact that this program has matured in stages. We had, on the one hand, the first points of contact being institutions and banks. They've sort of looked at and tried to interface with their existing customers on the lending side, and not even those who have deposits with them. When you enter into this space, when PayPal, and I won't even abstract further from not just PayPal, but other kinds of companies sort of entering into this space, what are you perceiving as both not just the governmental response to this, but also, other banks? Like, how are they viewing this movement of sort of new actors into the space and being one of the first to enter into it? What have been your observations on the ground?
Yeah, sure. So, and, the same day that we were granted, approval, Intuit was also granted approval, Square was granted approval earlier this week. I think more and more fintechs are going to get into this program. And what my answer to your question of like, how are banks viewing this might be a little surprising. I won't reveal the name of I talked to a couple of large banks about this very early on in the CARES Act process. And frankly, I think they were all pretty okay with fintechs coming into this, because I think there's a recognition that, again, when we're talking about some of the smallest, the most challenging to reach businesses, fintechs, as Sam said, kind of are really in a good place to be able to serve those guys. I mean, when you think about our traditional, before all this PPP stuff, our PayPal working capital product, 89% of the loans were under $25,000. When the SBA just released some stats in terms of the first $250 billion in the PPP, average loan size is $250,000. Tends to be, quite large, actually. A good percentage of our loans go to, actually, we've seen massive growth over the last couple of years in loans going to banking deserts, places where there's no bank for 10 or more miles. So, again, I think in this particular example of the PPP, and that's why I'm kind of just, in terms of PayPal's perspective on all this, it's been honestly a fascinating time to be at the company, because everybody has rallied around what the heck can we do to help right now? That's all that matters. when you've got this much economic devastation, what can we do to help? And the whole competitive thing, it's obviously still there, but people are trying to find out whatever they can do to help, whoever they can partner with to help, government, private sector, nonprofit. It is really an incredible time to be working on this stuff.
Usman, I'm going to ask you a couple of forward-looking questions. I mean, you've spent a lot of time studying small business. You know, do you have any thoughts at this point on what the small business landscape looks like post-crisis, if we can even think that far? And I guess a related question is, out of the last financial crisis or the Great Recession, we saw a shift to alternative data and underwriting that looked at things like cash flow as being a better indicator than FICO. Any thoughts on what the consequences will be of this crisis and how underwriting for small business changes over time?
Well, I think as first on your first part of what are small businesses dealing with and what are they going through right now? So it's a transformative time. And, you know, a lot of businesses are figuring out how to digitize. Some things are very, very difficult and challenging to digitize. And so as I really appreciated Todd's comments on the really small list of folks who are just now eligible for this program, who were probably hit the hardest because they were service providers, if they're sole props or really small businesses. And so in answer to your question, I think a lot of it depends on what happens next with this initial PPP program. And then as Sam mentioned, how we build out going forward, because, you know, if the loan size continues to be at 250,000 on average, you know, we're going to be in a very, very different environment in terms of what kind of businesses make it out of this particular crisis. Over the weekend, we provided a $5,000 loan to a chiropractor in Missouri that had been shut down, sole prop chiropractor, and nobody's going to get their back straightened right now, right? So, I mean, if we can figure out how to save those businesses in this time, you know, certainly the digitization and again, the fun part of being at PayPal right now, you're seeing this just amazing acts of kindness where people are using Venmo to pay their barber for the next like 2 or 3 weeks or months, and you know, you're seeing people buy digital gift cards. So you're seeing this evolution, and certainly, you know, underwriting and digital data points are going to be a natural outgrowth of that. But it's gonna be massively transformative, and I think the question is going to be, how can we make sure that the most underserved right now come out of this and are saved and survive through this? You know, I'm really, really hopeful that in the next tranche of funding, we really consider those smallest of guys and how we can get them through this.
You know, it's a little bit off the immediate topic, but mentioned sort of moving forward. We got an interesting sort of tweet from Brad Kimes, who observed that here's PayPal payments company, and this the question of payments is ultimately going to be one that reflects not just the sort of fintech payment rails, but to what degree blockchain or distributed ledger technologies ends up supporting these kinds of things in the future. I mean, with PayPal, you guys have such a diversified and increasingly diversifying business. I mean, is this the kind of thing that when you look forward about future crises, there will be more thought about, or is this something that is a little bit further off the beaten path for a firm like PayPal?
No, well, I think even before this crisis, we had stood up a blockchain working group. We've invested in blockchain startups on the identity front. I think there's a lot of excitement and opportunity for the solution set there. But I think, you know, on the payment side, one of the most immediate things right now is like, how can we get some of these stimulus payments out to people? How can we ensure that small businesses can accept payments right now? So if there are immediate things that we can explore with blockchain, that's great. But it's also just, you know, whatever we can do right now to improve the situation, get people their money as fast as possible. that's the focus of the company, and happy to chat with anybody about what we can do to help with that.
Thank you, Usman. This is a wonderful perspective, and thanks for moving on and joining us. Technical difficulties aside, so I guess we're going to bring on to really supplement this conversation, Braden McCarthy from Stripe Capital, and there he helps to direct strategy initiatives. I mean, we're talking about strategy both from the perspective of the now and also the future, particularly when we want to accelerate economic growth as this initial phase of the public health challenge starts to abate. Brad, great, wonderful perspective, and he is also a former policy advisor at the SBA and was at the White House National Economic Council. Braden, thanks so much for joining the program.
Oh, Braden, do we? I think we had a
happy to
blip there.
A little bit of latency on my end with the Wi-Fi. So I work on the opposite side of the house, and I want to just chat for a second, if I can, about PPP.
Braden, just a quick second. Are you able to load your picture so we can see?
There we go. Yes. So about PPP specifically, I think this all comes down to conversion rate optimization. You need to look at every step a borrower or lender must go through in order to get funds out the door. Each step introduces a new friction point or potential bottleneck. And the question needs to be, is that friction point or bottleneck worth it, given the moment that we are now facing? And so it is the accumulation of all those limiting factors that is what's preventing getting money out the door quickly. Sam mentioned a few of them. The verification requirements to comply with the alphabet soup of FinTech, OFAC, FinCEN, KYC, AML compliance, the payroll doc collection and review, but one we really haven't chatted about, which does involve us going deep into the bowels of the SBA, which Anne-Marie will be well familiar with, is E-Tran. And it is a name that I'm sure many folks who weren't familiar with the SBA hadn't heard of before, but I'm sure invokes a shiver in the spine of any lender trying to push loans through the system currently. So if we can talk about E-Tran for a second, as of last Friday, the system could only support, period, end of story, regardless of bank, 3,000 applications an hour. 3,000 applications an hour. We're now up to 7,000 applications an hour as of yesterday. So the big issue with E-Tran is it does not allow programmatic submission of applications to the SBA. It is an API in name only. It is an API that is meant to have a human on the other end interacting with a series of error messages the SBA sends back. Those error messages could be as simple as there's a comma or a dash in the business name, or their numbers are not rounded up. Things as simple as that. There's meant to be a human on the other end triaging these error items. Think about now a system that is trying to get 15 times the volume done through all of the SBA last year in a matter of days. And you understand why that last limiting factor that is E-Tran is a huge bottleneck in terms of getting money out quickly.
Braden, let me just jump in and ask you. I mean, let's talk about tech and tech serving as a solution. Yeah. So you're mentioning obviously the E-Tran system, the internal tech platform for SBA as a limiting factor. But that you also talked a little bit about KYC and the Bank Secrecy Act. Yeah. And I want to come back to that because I personally think that that's an area that we really do need to be focusing, because right now, one of the hardest parts of getting money out the door is identifying the end customer, the end small business that's supposed to receive the funds. Do you all have a view as to how tech can help with that? Is there a way to port KYC from an existing bank relationship to another entity using technology, using pipes that allows kind of the movement of information faster? What could we do? Is there anything that we can do now, or does this have to happen post-crisis?
Without question. I mean, I think the model exists today with most fintech lenders. Whether it is Cabbage, whether it's Bluevine, Stripe Capital, Square, we programmatically automate compliance with KYC, AML, BSA, OFAC, and FinCEN for our bank partners. And so I think one of the biggest points of confusion that we have tried to mitigate through conversations in DC is this perception that Stripe Capital or Square Capital, that we are lenders. We are not. We are agents on behalf of banks that are lenders of record. We automate the front end, the KYC AML, we collect the documentation. In some cases, we are actually co-underwriting with our bank partners, leveraging the data that we have, the payments data in the case of Stripe, on our merchants. But we do close to 400,000 verifications along KYC, AML, BSA each week at Stripe. Doing that and then doing that at scale are two very different things. And that, I think, is one of the reasons why you see a lot of banks say, sorry, we can only lend to our customers because we need to comply with BSA, AML, and KYC, and can't do so programmatically in order to support demand outside of our system. So partnership with FinTech there, I do think, will help the front end limiting factors. I don't think, though, that does anything to help the back end or mid funnel limiting factor that is eTran. So whether or not we rebuild eTran as a true API that exists in the cloud that can actually handle programmatic submissions or not, that is something we need to really figure out if we're going to use the SBA to get capital to businesses. The other point I would just make, we talk a lot about PPP, and understandably, considering it is, as of now anyway, the biggest vehicle through which to get government-supported capital to small businesses. But I do think this is more likely than not to be an L-shaped recovery, not a U-shaped recovery. We are going to be in a world in which businesses throughout the country are closed, either because they went out of business during COVID or are struggling to kind of get back up and running, even if there is no government mandate to stay closed. You're also going to have millions of employer-employee relationships that have been severed that may not come back overnight, that will lead to, temporarily at least, us traveling less, we spend less, going out less. That will be this kind of demand shock we will face potentially for months, if not for years. So all that is to say, I think that we can look at a lot of the failures of PPP in terms of getting money out the door quickly to businesses that need it, and start from first principles on what do we need to do now that can complement what PPP tried to do. And so there, I think we really need to go back to what is the goal? The goal is to keep businesses afloat and keep wages flowing. What is the best way of doing that? Number one, capital needs to get out fast. Number two, it needs to be digitally done. Businesses are not able to walk into a branch, nor are banks or fintechs, for that matter, able to stand up human processes to review and check documentation in order to verify a borrower's creditworthiness, or for that matter, their need. And so I really do think you need to be relying upon data that verifies what a user's need is in a way that can be done programmatically. And I think that is actually where the Squares, the PayPals, the Stripes of the world, and the Plaids of the world that are actually democratizing access to demand deposit account data can really help. Because at the end of the day, the KYC AML piece, that helps in terms of preventing money laundering and financial crimes. It does not help size demand, or size need, I should say, size a loan based on the impact that a business faced as a result of COVID. We do have, though, verifiable data to understand the need and the impact, and that is payments data, which is the proxy for revenue that every payments provider, from Amex to Stripe to Square to PayPal, has, as well as checking account data, cash inflow, cash outflow, that every bank will have on their customer, and that Plaid is helping to democratize access to for every fintech lender, as well as anyone else who wants to build pipes to it. And so to the extent possible, I really do think the Fed should be using its 13.3 authority to purchase any commercial loans that meet certain criteria. Number one, it must be sized off of verifiable data, revenue or DDA data, to understand the need of that business in terms of cash outflow or in terms of revenue, to build a bridge loan to better economic times. Number two, it must pass KYC, AML, BSA verification requirements. And number three, I really do think that we need to enable payments providers, enable fintech lenders to work within the banking system with our bank partners. in order to get these funds out the door.
I think that perspective is invaluable, to work, to at the same time while working through the crisis, creating the kind of lessons learned to frankly think through how to upgrade not just our crisis response, but our existing payment rails and regulatory infrastructure. With that, I want to say thank you so much, Braden, for joining us. Just fantastic observations and comments. And you've really opened up a way for us now to talk to John Pitts from Plaid, and who's really been at the forefront of these questions of data, open banking, and the like. John, are you there? Thanks so much for joining us.
I'm here, Chris. Dan, good to see you guys. Thank you for having me. I'm assuming.
Well, I'm sure you probably heard. I mean, you had Stripe Capital there singing your praises, and I think it's a really interesting perspective that Plaid brings to the table, particularly because your business is data. Maybe you can sort of help us to connect this question of sort of what open banking does to the needs of the moment, to sort of expand our understanding, frankly, as to the kinds of opportunities presented with digital infrastructures in moments like these, and what exactly it does to help to facilitate that underwriting process and lending process for people who are facing really dire economic circumstances.
Yeah, absolutely, Chris. Great question. So taking us on sort of a ancient history tour way back to the 2008 crisis, Dodd-Frank.
I don't remember what there was a crisis in 2008.
Yes, the one we thought was going to be the only one in our lifetime. Little
yes.
did we know that was the practice run for this. So coming out of the 2008 crisis, Congress passed Dodd-Frank, and the thing that was incredible in that is a single section that's only 75 words long. Dodd-Frank 1033 said, consumers have the right to access their financial information on their bank accounts. Out of those 75 words sprung most of fintech services that consumers take for granted today, because they're suddenly able to access and share their data with third-party services to get products they want. What has become incredibly apparent over the last 3 weeks is that same right did not extend to small businesses. And so in the middle of this crisis, as you needed small businesses to have access to some of their essential data, all of the infrastructure wasn't necessarily in place to help them easily do that. We and a bunch of others, and really incredible compliments to the entire fintech community, and frankly, the bank community as well, for moving so quickly on some of this, have really spent the last 3 weeks trying to build as much of that infrastructure as quickly as possible, specifically to meet the needs of this program. And what we've seen is the demand is really clearly there, both on the small business side, but also on the lender side, to help move these loans quickly by making the underwriting and qualification process as easy as possible. And I think, Braden talked about this. Every single friction point is a way in which a small business might drop out. And so easing that friction by giving direct, immediate access to small business data is going to be essential for this. I think, though, if we look forward, it's going to be essential to maintain that access so that you can see the same sort of flourishing in small business fintech that you saw in consumer fintech over the last 10 years. And, one of the unfortunate things we've seen is there was an initial reaction by some companies to say, hey, is this an opportunity to charge money to small businesses to help them pull together the materials they need to apply for these loans? That's not the additional friction that small businesses need when they are fighting for their life. And I hope this will be a moment for Congress and everyone else to recognize that small businesses have the same essential need for open banking, access to their own financial data, that consumers have and that consumers have enjoyed for the last 10 years.
So John, let me pick up on this and ask you, so there's two areas that I see data playing a critical role. One is around identity, as we just talked about, identity, KYC, AML. And the second is around this idea of underwriting. And I actually want to ask you, I mean, if we look at another stimulus bill, is there a way from a policy perspective to facilitate kind of the movement of KYC data so that we can really satisfy that requirement same day for many of these Main Street small businesses? And two, do you think we should have an underwriting component going forward? Should we be pulling kind of prior payments data, bank data, so that we can assess need for small businesses rather than kind of a more blunt force instrument of just saying, okay, here's the amount of money we're going to put out and let's just get it out as quickly as possible?
Yeah, great questions, Dan. So let me take the first one on KYC first. I saw something really interesting from FinCEN yesterday. They put out an FAQ on the PPP program and said, one of the questions was, if I'm a bank and I already have an account for a customer who's now applying for a PPP loan, do I need to do a new KYC and open a new account for that customer? And FinCEN said, no. If you've already got verified information on that customer, you can rely on that verified information as your KYC check to initiate the PPP loan. The thing that's really interesting to me, Dan, is I think you can extend that logic. So let's say you've got Bank A that has already made all the loans they can, but they've got an account for the business. If Bank B can originate a loan and check using a tool like Plaid the account information from Bank A, why not let Bank B rely on that same information for KYC? And then to extend it one step further, if Cabbage can access bank information at Bank A and other fintechs can access that same information at Bank A, why not let them rely on that KYC check so that you don't have to do a KYC check for the same company multiple times when that KYC check has already been completed? I think we are at a real moment now where the unwanted friction caused by that is going to become very visible, has become very visible. FinCEN has taken the first very, very small step, but I think there's a real possibility to have the Prudentials and others look at this program and look at the desire to accelerate this lending as quickly as possible, and at least test out whether that's a reliable way to allow KYC portability moving forward. On the second question, really just sort of, what do you want to most, like how this data can get used, where it's most useful going forward, or did you want to get at a different point there?
Well, I was asking you more if that should be part of kind of an underwriting requirement kind of going forward. But
I mean, I am not a macroeconomist, so I'm not even going to try to opine on whether we should switch from what is effectively a helicopter drop, sort of keep everyone alive program into an underwriting one. I should have said qualification in terms of instead of underwriting for what's here. But it does raise something that no one has yet talked about, Dan, which is the next stage of this program, even if no more money comes out, and I hope more money does, because as everyone has said before, the need is clearly there. There's a next stage of this, which is small businesses are able to convert 8 weeks of expenses that are covered by this loan into a grant, a forgiven loan, right? So it's not even a loan that has to be paid back. In order for a small business to do that, they have to demonstrate that the expenses were qualified expenses. They have to prove that they used it for payroll. They have to prove that they used it for rent or for utilities, other expenses that allow them to convert this from a loan into a grant. That's something that fintechs have been doing for 5 years now, right? That really good categorization and cleaning of data and feeding it back into a program. I think, looking 8 weeks ahead, and I know 8 weeks is an eternity right now, there's going to be a huge value for small businesses in recognizing this as a grant, not a loan they have to repay, if fintech and banks can work together to rapidly spin up that categorization service and make sure that the right payments are tracked appropriately and turned into forgiven loans.
John, thanks so much. I mean, this question of data, generating data, data that you can use, data that can be relied upon, and data that's actionable, both for regulatory purposes and for market purposes, is obviously something that the market's always known, but frankly, something that, as you've noted, when it's not there, it can help to exacerbate problems, and problems that seem minor in good times can become certainly major problems in times of crisis. But thank you so much. We're going to wrap up our conversation, this question of data, to the question of alternative data, and what does it mean? What does the crisis mean for fintech companies who are thinking innovatively about how to service people who are now being dislocated by this economic crisis? And we have Melissa Quade from FinReg Lab here to join us. Melissa, are you there?
I'm here. Can you hear me?
I can hear you, and we can see you. Wonderful.
Excellent. Yay, success. I know we're getting close to the end of the hour, but thank you both for having me on. I'm glad to be a part of this really critical conversation right now. So,
no, thank you. You've been really at the forefront of thinking through sort of the questions of alternative data, and obviously in a different kind of a context, but certainly in the fintech context for sure. When you look at alt data, not just sort of getting the data that's maybe on a bank account or existing for purposes of immediate underwriting, but alternative sources of information, how do you think that this crisis is conversation, and is alt data itself a concept that may need rethinking, given all of these cash flow dislocations that are arising in the economy?
Absolutely. Let me quickly just put a plug in for the prior conversations, and Dan in particular, your questions around KYC and KYC portability and data for satisfying KYC purposes is oh so important. I want to point out that yes, it is true, FinCEN has been making some signals to suggest that banks can rely upon existing KYC processes. Banks are still anxious about being able to satisfy know your customer requirements with customers that they don't already serve. And as we've heard repeatedly, we've got 24 to 30 million really underserved small businesses who are going to be in need of these funds. So I do want to talk about alternative data in the context of underwriting, but I think it's really important that we are distinguishing the need for emergency funds to keep these businesses afloat or even contemplate bringing them back online, and how important the PPP program is around that. I would also just point out on the data sources and infrastructure, the government itself sits with enormous amount of data. IRS has a lot of, as we all know, very basic name, address, ITIN, or your typical taxpayer identification number. I mean, these are data sources that one could contemplate if we're going to see a new world in which we're doing identity. Those sources of data could be really helpful sources for thinking about something that generates something that's more akin to a digital identity infrastructure. So I think looking to the future, which is I know some of what you wanted me to cover, I think we need to be thinking about those types of opportunities. On the alternative data, you all know this well. I don't know if the callers do too. We've done a lot of research, empirical work, even with some of the participants on this call, looking at cash flow data and what we can see from a bank account and what that information offers in terms of underwriting, especially hard to serve both small businesses, but also consumers, individuals who may have marred credit from the past, who may have no credit history, or who may be what we call thin file. Our research showed with the lenders that we evaluated, that data actually is predictive. And it is distinct in its ability to predict risk from traditional underwriting methods. And so we absolutely see the value of looking at transaction level activity, what's happening in a small business's account, as being really critical as we go to look to the future and how we are thinking about, somewhat, Dan, to your question, how are we contemplating bringing life back into the small business sector as we do need to at some point think about extending safe and affordable credit to these small businesses. So, you know, in the immediate term, I have talked to some fintechs and they will tell you that it's hard to assess what's happening with these small businesses when they simply have no money, obviously revenue coming in the door. I do think though, and I have picked this up from some of the conversations with other fintechs, they're going to be quickly evolving as money start to flow in, even if it's PPP money, how then those businesses are actually making decisions upon expenditures, that level of nuanced information about how those businesses are making decisions and managing their business needs will likely probably start to indicate some level of credit risk. And so, and I would also say that type of data is so much more timely and accessible than, you know, what we're going to be seeing in terms of how people were making decisions on how they're paying credit and debt obligations. So I think, well, in the very sort of triage moment, cash flow data of the type that, of an alternative data type that may be especially valuable for small businesses, especially underserved, may feel a little flat. I think pretty quickly as we start to see money coming back into the businesses who make it into their accounts, that it will offer some indication of the ability to extend credit to those small business borrowers.
Well, so that's really fascinating, and you know, maybe it's a final question. But you've done obviously so much work thinking about sandboxes and testing. Of course, is kind of the driver behind FinReg Lab. Any thoughts as we come out of the crisis? You know, what are some of the most promising areas that we should be continuing to develop, and then what should we avoid?
Yeah. Well, let me talk about, I think we should avoid putting our heads back in the sand and not, somebody said this earlier, not learning from this experience. And I'm optimistic that there are enough sort of innovators and policymakers who really, I mean, even on the bank regulatory side, there is thirst for understanding how technology and data can be a force for good in helping to get over some of the, what was the term at the beginning, these sort of kludgy processes, clunky processes. And so I'd like to think that we will avoid that, but I think we're all going to have to do our part there. I do think looking forward, we're going to have to really start to contemplate how are we leveraging data of a variety of sorts, because there's going to be a lot of need both on small business and consumer side around the servicing of debt obligations and debt management plans. How are we going to be really holistically looking at the financial picture of small businesses, and I would say consumers too, and coming up with humane ways that we're going to be helping these businesses and consumers get their financial footing under them, while still obviously they're going to have to manage through debt obligations, credit obligations. And so I think the data and technology piece is going to be a really important way for a holistic approach to trying to both bring these businesses back to life, but do it in a way that they're going to be able to succeed and get back on their feet.
Melissa, thank you so much. As Dan said, really interesting and just trying to predict and to see how the fintechs themselves evolve in terms of their methodologies after this crisis is going to be fascinating. Thank you so much for joining us.
Absolutely. Thank you both.
So I guess we're about to wind up this program, but I did want to ask you, Dan. I mean, you know, you've heard now some really interesting perspectives all across the sort of fintech ecosystem. What kind of takeaway points, you know, on notes and thinking through things? What kind of things have you taken from the conversation?
No, thanks. Look, I think it's been awesome, and so thank you to all of our participants. I jotted down two big picture takeaways. Number one is that we're not done. You know, the PPP program and the emergency grant program, that's getting some funding out, you know, in hopefully relatively short order. But it sounds to me like we still don't know how this crisis flows through. We still don't know what the needs are going to really look like for our economy coming out of the crisis. And so I think Melissa's points at the end, what does underwriting look like when we start to emerge from this crisis? That's a huge, really difficult question. So I think that we're not done. Some of it might be follow-on funding programs. Some of it might be bigger picture thinking about how policy can help support small business and the economy. My second big picture item here is that, if there's a common thread, it's this notion of digital infrastructure. And that's certainly been one of my big takeaways over the last few weeks, is that, to the extent that our economy is continuing to be productive in any way, it's underpinned by digital infrastructure. It's our ability to do what we're doing right now and actually communicate and have a productive session. And I think it's that same technology that's going to be allowing us to move information about identity, information about payments. And so we just need to be very smart and forward-leaning when we think about policy frameworks that can facilitate that. So I'm heartened that there are these tools out there that we have at our disposal. But again, I think there's going to be a lot more work to be done, and we're certainly not done yet.
Yeah, I think that's what I picked up too. I mean, is this innovation directive? For a while it was deemed to be a choice, not just among market participants, but also the government. And you're seeing that, the government, in terms of its processes, needs to evolve and needs to innovate. And it's not a choice. It's going to be something that's going to be necessary as in order to service the needs of people in the country. And at the same time, even for larger actors, larger financial actors, they're going to have to innovate their own processes. And even fintechs, the small, nimble firms, aren't going to be able to just sort of sit on their hands. The economic situation is quickly evolving, and that's going to itself require new kinds of both technological and business strategy. Interesting to see what happens in this new eternity of 8 weeks. But Dan, thanks so much for joining us, and again to everyone who's watched the show. Again, this is part of a series of programming that we're hoping to bring to viewers, to democratize information that's really impacting everyone. But thank you to our viewers again for joining us, and to our wonderful participants. Thank you.
Thanks, Chris. Thanks all.